Hello, welcome to the FX Big Picture podcast. This is a series of podcasts where we will discuss a wide variety of topics and provide a rather different perspective from our experiences serving UK customers at NatWest. My name is Duncan Maccabe from the UK Corporate FX Sales Team. We have James Newman today from the Financial Institutions FX Sales Desk. And of course, we are joined by our FX Market Strategist, Neil Parker. So today we're going to talk about supply chains. The last year has forced a thorough supply chain examination for companies. And I think today we're going to focus on resilience and potential need for these for supply chains to be improved. But at what cost and potentially what impact on service? So Neil, I'm going to hand over to you first. Can you give an overview on the current situation?
Yeah, I guess the thing that we're looking at here with regard to supply chains is that not just because of COVID, but also because of a number of other factors like Brexit, a lot of businesses are looking at where things are coming from and the cost of that and the potential future cost of it. But more importantly, and I think you've already touched on this, they're looking at the resilience of supply chains. We have a number of sort of situations looking back through history where supply chains have not proven to be as robust or as reliable as they were believed to be. So consequently, I think you look at this on several separate from several separate perspectives. You look at the reliability and robustness. You look at it in terms of price, but you look at it in terms of sort of future sustainability and how trends in other economies may well take some of that sort of resilience or that pricing differential, so that pricing benefit, or indeed that just the issues around choice away from people that are reliant on supply chains that are not domestically located. So I think people will come at this point on supply chains of should we reshore and how much will it cost us to reshore production? But actually, I'd be looking at this in terms of, is it sensible to have supply chains that are located only in one geographic region, and therefore they're at risk of geopolitical problems? And is it sensible to have them located in one geographic region when you've got the issues, as we've seen in the past, of that geographic region being knocked out for a number of reasons, whether that's some sort of natural disaster or some sort of man-made problem?
Could that be blocking a canal, for example? In the man-made sense, or
I mean, we're not talking about the Manchester Ship Canal in the sense. I'm assuming we're talking about the Suez, but you can see that there are problems when you're reliant upon one route to market for a lot of the goods that you're shipping, and where alternative sources, because of margins on those goods on that product being so low. That other alternative routes of transporting that good and of transportation are just not within your grasp as as an importer in particular. That's what we're really talking about here, is imports. But of course, I mean, we could be looking at this in the opposite direction, given some of the global trend changes that we're seeing with regard to some areas of heavy industry. So we might be talking about this in terms of supplier reliability in the opposite direction from Western economies to Asia, particularly in terms of the way in which demand is changing.
I think it's really interesting, this focus on resilience. It feels that the pandemic has kind of changed the mindset of many organizations from just in time to just in case, kind of looking at the resources both that they import and also the chains that they have already in place. What I think is quite interesting in terms of this whole globalization versus nationalization side of things is how and what this does for inflation and where these supply chains end up getting located. It feels almost in many respects that the work that Trump did, years before the pandemic in terms of bringing industry back to the US, kind of kicked off this process. And in many ways, the pandemic has made many countries look at their own weaknesses and their reliance on nations like China and think about, actually, do we need to be producing some of these things in-house?
Yeah, I mean, I just come back on that as well and say you've actually highlighted where the trade-off really here is. It's between the resilience of supply and the potential for having multiple sources of supply over a variety of different geographic regions and price. That's a simple trade-off.
And Neil, we can almost go back through time as you are the person that's experienced the longest period of history in your life.
You're saying I'm old, aren't you?
Yeah, once again. So how do we get to this point over the last few years? If we go to think about the globalization history, was it always a path to production at the lowest cost? How have we got to where we are now?
To a great, 1970s it was made in Japan, 1980s it was made in Taiwan, and then made in China, and that was a price debate. That was only a debate over price, and you've seen changes in terms of the global supply chain that basically reduce the impact of shipping costs. I'll use one specific example. We've moved away from having really big TVs, but they were both deep as well as wide, and now we've got very wide televisions but very skinny televisions. And at the beginning that wasn't because the picture quality was better, but that was because you could ship a lot more of them. In the same container you could ship 5-6 times the number of TVs, but you weren't getting an improvement in quality. The improvement in quality came thereafter, but that was something that helped to hold down pricing over a longer period of time. So it comes back to price again. So there are a lot of things that have been done to mitigate against these very long supply routes in order to hold down price, which has kept the production in those geographic regions. But again, going back to the sort of point, it does also boil down to price that's driven by exchange rates. And the reason why you moved away from made in Japan to made in Taiwan to made in China was down to the movement of exchange rates to a degree as well. You saw a very sharp appreciation of the Japanese yen, and you saw over that same period a very sharp depreciation of the Chinese renminbi. And that's where the switch around occurred.
It's interesting that you mentioned foreign exchange, and another one of those sort of market inputs is commodity prices as well. And it's sort of quite famously through the pandemic and to where we are today is the cost of a container and to be shipped across to the West is materially more expensive than where it is, something like 5-fold. And so, what impact does that have, and potentially for the dynamics to change going forward for supply chains?
Again, if we look at where we were in the midst of the pandemic. But this was a trend, by the way, that was happening through the second half of 2019 and early 2020. The Baltic Freight Index that everybody watches in terms of shipping costs had dropped from $2,500 to under $500, and now it's at sort of over $3,000. So you've seen a turnaround, but let's look at this in terms of over a longer period than just the pandemic. You are seeing fresh sort of multi-year highs in shipping costs. One of the reasons for that is because a lot of the trade is one way. So you're not getting that two-way flow of goods, which means that the containers are being shipped back. So you've got a stockpile of shipping containers in Europe and in the US, because stuff isn't then being piled onto those shipping containers to be shipped back to Asia. So that is an additional cost that's generally being paid for by those that are importing the product. They're having to pay to ship the shipping containers back. And so there's going back to one of James's points, there's an inflation implication here. There's an immediate inflation implication. But there's other things. You mentioned commodity prices. You know, the CRB index, which is a broad measure of commodity prices and raw material prices, has more than doubled over the course of the last 14 months. So that's another input into higher prices, which might then start to make people question about the other inputs that are going in to the production process. And this again brings us back to resilience, reliability, and also multiple locations. You know, because prices generally are now higher, is it time to now look at investing elsewhere, not just in the same region, but elsewhere geographically, to give yourself more resilience in case of natural disasters or man-made disasters? So the history of this, alongside the increase in commodity prices, I think brings us to a very interesting point where you know that there's going to be inflation. Do you then add an additional piece to that inflation to make yourself more resilient in terms of the multiple locations that you can then draw from in order to maintain supplies and give yourself that supply resilience?
Yeah, it's also interesting, I think, in the day that if we think about the consumer in our private lives, we can be so used to receiving our goods almost next day for so many different things, and you know, by bringing stock or supplies in, you know, nearshoring or bringing it closer to you, then that surely will add to a service. But I guess it is, at what cost would that be achieved? And I wonder what that inflection point would be, and what the impacts would be to inflation and other aspects to the consumer.
I mean, if you were to look at this in terms of a price elasticity perspective, so where does it then start to hurt you in terms of demand for your goods? I mean, there is a clear difference, a clear disconnect between the very expensive items, which likely have a more sizable margin priced into them, but not always, of course, versus the very cheap, which has got a very small margin, and that really sort of begs the question: how much more would we be willing to pay to get production closer to home, or even to home, depending on what market you're talking about? I don't think, like, let's take clothing as an example. I don't think you're ever going to get to a position, at least certainly not in the next sort of 10 or 15 years, where you're considering reshoring production of clothing and footwear and those sorts of things. The margins aren't there. There doesn't seem to be the elasticity as far as pricing is concerned. That means if the pricing were to change, that there wouldn't be a significant reaction in terms of the amount demanded. And of course, we're talking about the demand side of the equation. Of course, there's also the supply side of the equation here as well. So I'm not convinced that we're going to get to a point in some goods where there's any realistic prospect of nearshoring production. But there will be other areas and elements, and we could talk about certain sectors like the car industry, where parts are currently predominantly made in Asia and then shipped back, or they're made in lower cost economies and then shipped closer to home. There is definitely a case to argue that with the changeover that we're seeing from carbon-based fuel vehicles to battery-powered, that we may well see that production much closer to home. You know, I mean, otherwise, what's the, you know, we hear a lot of companies talking about their corporate social responsibility and talking about their environmentally sustainable and green credentials, but you're still shipping stuff from halfway around the world. You know, that doesn't make sense. Yeah, you're making something that's much more environmentally friendly, or purportedly much more environmentally friendly, but your supply chain isn't. And that's where I think there's a potential cost, price versus sort of CSR or ESG trade-off, which may work in favor of prices going up in order to benefit the corporate social responsibility. Yeah, James, you wanted to come in on that?
Yeah, I think there's some very, very valid points there. And thinking about how this kind of feeds back into the FX side of things, all this really points to is supply chain disruptions and their knock-on effects for inflation being really a more medium-term shock as opposed to a short-term one that's quickly forgotten. This really does complicate the life for central bankers, who are very busy disentangling supply and demand effects, looking at cost push, demand pull, inflation, how transitory these will be. I think it's quite interesting if you look at, say, the US central bank, the Fed. Are they likely to continue to retain their dovish bias and push back on some of the market pricing as we've seen over the last couple of weeks? And if so, does that mean that we maintain the short dollar trade?
Yeah, I mean, that's a good point as well, because I think they're still looking at this, the latest inflation spike that we've been seeing in data recently, over recent months, and they're saying this is cost push. This is cost push inflation. We're pretty sort of okay. We know how to deal with that. If you're then starting to see demand pull, and this is where again we go back to supply chain resilience, because demand, I think, is undoubtedly recovering faster than supply. So if you're getting some demand pull inflation because there are shortages of things, and we're not used to having shortages, then I think that puts those central banks in a very tricky. Say the short dollar trade then becomes a more questionable sort of trade to hold. But the other point is, I don't think any central bank over the last 20, 25 years has experienced demand pull inflation. They've gotten out of the habit of looking for demand pull inflation because it's never been there. And there hasn't been any cost push inflation because there's been a plethora of options with regard to again, supply chain resourcing. And there isn't this time. And this actually leads me on to one other element, which is we are still reliant upon a China that exports a sizable proportion of its production, and yet the Chinese economy is utterly transformed from where we were, not just in the 1980s and the early 1990s when we went through those series of devaluations of the Chinese renminbi, but going back, you know, even to the mid 2000s, the Chinese economy looks nothing like what it did then, and there's a lot more domestic demand for their own production. So that's another thing that central banks are going to have to deal with, dealing with a China that doesn't or is unable to export as much. You know, what do you do? What do you do then? What do prices do then? You know, that again could lead to more demand pull because China is in of itself a bigger the global economy. What do you think, Duncan?
Well, I was thinking on the corporate side, if there was a pivot to alternative suppliers on in different countries, the consideration is, again, this is probably over a medium to longer term, but so investment decision, there may well be investment in other countries, which may be a larger transaction, which is worth assessing the risks and which country, which currency, and then also the transaction elements. It's kind of away from the inflation story, but there will be in terms of for importers, I don't think that unless there's a huge demand changes, I don't think there's going to be a huge difference to say sterling selling. It will just be in a different mix of currencies. So let's say instead of 50% dollar or renminbi buying and euro, there might be another in the mix there, and there will still be the same proportion sold in sterling, for example. But you also saw the dynamics sort of post-referendum result for the UK's membership of the EU. It was after that there were many companies that looked at investing in warehouses in Europe or in new facilities or investing elsewhere, where others decided against it. I think that there will be either a risk accept or a risk that will be mitigated in some way, shape, or form.
I take the point about Brexit in terms of we saw a lot of companies looking at sort of co-locations for warehousing or even manufacturing facilities, but that was really only after the vote had been taken. That wasn't there was very little preparation prior to that, and there was this, I think, an unwavering view that the UK would vote to remain, even when the polls closed. It's still like, well, yeah, it's going to be close, but they'll still vote to remain. And so not a lot of work was actually done, and then there was a mad scramble, and actually what that did is it forced up the prices of all of the facilities, because you had a limited supply of facilities that could handle warehousing or manufacturing in the locations that businesses wanted them to be present in, and so everybody was looking at the same stock, and so you could look at that from again, going back to the whole thing about, well, do you want to reshore? What locations do you actually have available in order to do that, and are you just going to push up the prices again? So yeah, I think just we've talked a lot about sort of bringing stuff back, but what about is the infrastructure in Western Europe or in the Western economies sufficiently developed in order to be able to handle that increase in production, warehousing, distribution, and all of that? Have we got enough? This is another one to throw into the mix. Have we got enough resilience in our energy industry? Have we got enough resilience with regard to our transportation network in order to handle that? And I'd argue probably not at the moment, because we're going through a change there as well, which is probably going to put prices up also.
I think the ability for many countries to actually bring stuff back and the relevant supply chains that they're able to build and develop in-house are largely idiosyncratic to each individual country. As you mentioned there, rail transport networks and also energy are two crucial considerations, especially to take into account when you have such differences between the UK, Europe, the US. I think from a kind of institutional perspective, I think these are interesting things that a lot of people are looking at, and how they factor one into the potential future growth longer term of various economies, whether Europe is in a solid position to capitalize, given its location potentially towards resources in Africa, and whether it's able to capitalize on its position in terms of its location, close to Russia, close to Asia, close to the East, close to the West. And also, I think it's interesting to think about how various central banks react to some of this cost push and demand pull inflation that we see. Each of the individual central banks have various different reaction functions, and some may see these increases in prices as more transitory than others. And therefore, there will be consequences for that. The Fed, the Bank of England, or the ECB, the European Central Bank, may have different reaction functions to this. And this will dictate how institutional investors look to position over the next few months and coming years.
I think we can talk about this all day. It's there's quite a lot of it's quite a lot of moving parts. There's some definite sort of key considerations and themes to draw from this, and I think when you're making the decisions on whether to make a change, there's a substantial factors to take into account. And I think, Neil, have you got any closing remarks for this?
I'd just say this: everybody basically beat up China, like with regards to the pandemic. But it's worthwhile noting that China basically supplied the world with PPE. So actually China should be credited with spinning up a lot of their production, or moving a lot of their production away from what they were used to producing to PPE equipment for the pandemic. But that does beg the question, again, going back to the whole resilience thing, where is the capacity elsewhere within the Western developed economies? And the reason I say that is because China's focus is shifting. Their focus is shifting away from supplying the rest of the world to supplying its own domestic population. And that's what those businesses that import from China are going to have to, in my opinion, really consider when they're looking at 5, 10, 15-year plans as far as investment is concerned. That's a major consideration, that the resilience, the robustness, and the reliability of supply chains, particularly from China, may be challenged, not because of China's domestic capacity to produce, but because of their demand. It's the demand side of the equation that's going to change much more rapidly.
Thank you, Neil, and thank you everyone for listening, and join us again soon for the next edition.